Hello.
Recording in progress.
Hi, good afternoon or good evening, everyone. We will be just waiting for 2 minutes so that all the participants can join, and then we will start. Hello, Sanya, you can hear me? Hello, anyone can hear me? If you can confirm.
Yes, we can hear.
Okay, Sanya, can you share the screen so that we can start?
I'm sharing my screen. It is want host disabled participants. Can you please access me?
Just a second.
Yeah, it's showing an error.
Just a second. Okay, it's fine. I think I have to share my screen. There is some
Error, I
problem.
think.
Yeah, okay. Okay, hopefully the screen is visible to everyone. Thank you so much, everyone, for joining this webinar today. Um, uh, as usual, we are trying to update our members and non-members on different topics, especially on IFRS stuff. So this is today we are going to update you all about IFRS latest amendments and updates and we may not be able to cover all the topics, but we'll try to cover as much as possible. So my introduction, members are well aware about me, and I'm representing myself, even Institute of Financial Accountants of UK, as a regional director for Saudi Arabia and Bahrain. I'm also fellow member of both institutes, along with I'm affiliate with CA Pakistan, and I have working experience with some big fours and as well as industry, and worked in different countries. I can say for different engagements across the globe, um, especially in Southeast Asia or Far East Asia and Middle East. Um, I have more than 14 years of experience for with regards to IFRS conversion compliances, merger and acquisitions, and so on. Apart from that, I'm also trying to be connected with the education sector to run the numerous on-job trainings, workshops, and CPD sessions. So this is our content, which we are going to run through today. Um, uh, okay, just to start with, if non-members have to bear with us for a few minutes, I can say 5 to 10 minutes, where I have to deliver some important message to the members of Institute of Financial Accountants of UK. It's very much important to have done their renewals as well as the introduction for non-members. With regards to IFA, I can give a little bit introduction. Institute of Financial Accountants is an internationally recognized professional accounting body, providing dedicated support to small and medium enterprises and small and medium partnerships. We are the part of Institute of Public Accountants Group. That is the world's largest SME focused accountancy group with more than um, I can say 49,000 members and students across the globe, in 100 countries specifically. We are recognized by Her Majesty Treasury to regulate our members for the purpose of anti-money laundering or money laundering regulations, as well as we are the full member of International Federation of Accountants, IFAC, and the IFAC is the global accounting standard setter and regulator. Our focus is, as I mentioned, is small, medium enterprise and partnerships. Let me just introduce here Infotexes. Infotexes is a startup with regards to accounting and finance service provider, including like bookkeeping, compliances, some technical accounting aspects. So the services can also be provided along with we have another division for the learning and ERP implementation and actuarial services. Important message for, sorry, I'll take again 5 more minutes to go back to the original topic. It is important for the members of Institute of Financial Accountants who have registered via Institute of Financial Accountants, not through IBA. So renewal of membership is very much important for them. So all those activities should be completed by 31st December. So first, they can log in using their membership details, and they have to make sure their personal details are up to date, and they have to update their CPD records. CPD records, normally a requirement is 40 hours in a year. 20 should be verifiable and 20 non-verifiable can be accepted. The important thing is the third step. You have to complete your annual membership return. I will also share with you some material as well as the video where and you can see how to renew as well as file your annual membership returns. We have many cases where where our members have paid their outstanding fees yearly, but they have not updated or completed their annual return. Due to that reason, they might have to face the disciplinary committee and leading towards the cancellation of their membership, or otherwise high penalties would be charged, which is, I think, sometimes it's I can say multiplier of your fee. So that's why just paying the outstanding annual fees is not the renewal, but you have to complete your annual membership return. And the deadline is 31st December 2023 as usual. I'll be sharing with you these slides so you can see and go through later on how to log in. By the way, members know how to log in, and then and how to renew and update. So with this bunch of slides, you will see the initial slides how to renew. This is for the members of institute only. Now payment is important. You can pay members knows normally through credit card or whatsoever the way bank transfer, but still we have installment option open. So for installment purpose, you have to, if you would like to get the installments, you can log in and you can have installment for your membership fee before December. It's automated process, but once January will come, you cannot get the installment option through your online account. You have to call to membership team and they will set up the installment over the phone for you. And thank you so much for the time, and we are looking forward to support you during 2024. Now I'm just moving to the topic, and on the topic side, we have, I believe everyone can hear me. Sania, if you can confirm, you can hear me correctly.
Yes, I can hear you correctly.
Sania is also supporting me to run this webinar, and if you have any questions, as usual, you can raise your hands. I can see a few hands have been raised as well as a few questions, but I'll answer later on. Okay. Okay, anytime if you have question, you can raise your hand and I'll see, and I'll either open up your mic, or then we can, or you can type the questions. Now the topic which we are going to start is, one is IFRS latest amendments and updates. Along with, we'll try to just give you a brief about IFRS sustainability disclosure standards, year-end reminders with regards to accounting and finance and IFRS stuffs for annual audits, and then we'll be moving towards the Q&A sessions along with details of upcoming webinars. Okay, so what we are going to cover today, mainly the IFRS amendments which are effective for this financial year starting from 1st January 2023, as well as we are going to touch base for updates as well as the amendments for the next year 2024 as well. So then we will also talk about the future developments. We have two hand raised. Okay, Sayyid Raza, if you want to ask any question, otherwise you can lower your hand. Okay. Moving to the topic, the first amendment, which has been effective from the reporting periods beginning or after 1st January 2023, is disclosure of accounting policies. Disclosure of accounting policies for IS1. It seems to be a small change, but it's really an important, or I can say a big change, where the IFA changed the definition for accounting policies with regards to disclosure only. So the earlier the preposition, sorry, the earlier you had to disclose significant accounting policies. Now this definition has been changed to material accounting policy information. It looks that there is no difference, but really there is a difference between the words significant and material. Let's say I can say, so before I go into further detail, if anyone can tell what would be the difference between material or materiality and the significant. Okay, so we have to run quickly. So what I can say, okay, I have allowed Rizwan to talk. You can speak. Welcome, Salam.
Sir, what I have understand, the materially it stands for the information that significantly or that materially impacts the decision of the stakeholders and shareholders on the information that is being disclosed. That's what
Okay.
materiality stands for. And for significance, it's again really resembling words. It's synonymous type of word, but you can I can not explain that that word, but material, what I have understand, it's major information that that materially impacts the decision of the shareholders.
Yes, materiality, with regards to materiality or material, you are absolutely right. So materiality is inherently subjective term in the nature, and it enable a company to or an entity to measure and disclose only those transactions that are significantly large amounts to be concerned for the users of financial statements, whereas significant implies as a high level of importance only. Like, for example, revenue can be a high level importance for your financial statements, but sometime or in some cases, revenue may not be material, I can say, account head or class of transaction for your financial statements. So, so significant implies to a higher level of importance than the material. So what we can say, rather as a boilerplate or just having the copy paste of significant accounting policies from one financial statements to other financial statements. Now, the IFRS has standardized in a different way. They are saying to disclose those accounting policies which are material with regards to the financial statements of a particular company, and it has really concern or impact on the users of financial statements. So now, for example, like earlier, as I mentioned, leasing or let's say property, plant and equipment cost and residual or useful life or depreciation techniques. All the companies were disclosing in their financial statements as a significant accounting policy, whereas in their financial statements, those account heads, maybe property, plant and equipment or revenue, were not material. So now, so whatsoever is material for your financial statements or for an entity financial statements, then accounting policies should be disclosed accordingly. So how standard gave examples with regards to material. So they are saying, let's say that you are changing the accounting policy from one to another. So it means that is material for the users of financial statements to understand. The other example they have mentioned, like if you have an option of policy, for example, either you have to follow the cost model or the revenue or the revaluation model for your property, plant, and equipment. So there you have options. So it's material to be disclosed. Then what we can say, policies developed in accordance with IAS 8, I mean change in accounting policy or estimate, as well as the significant judgment and assumptions are involved. Let's say if in some cases, if financial instruments required level 1, level 2, or level 3 kind of valuation techniques for your financial statements or for an entity financial statements. So in that case, that policy will be considered as a significant judgment or assumption. So similarly, accounting treatment for complex transactions will be considered as, I can say, the material accounting policy information, rather significant. So till now, if anyone has any question, I'm not going to reply on general questions. Okay. The next one, the next change, which, so before moving to the next, I'm just reminding here, this change has already been implemented, and it is effective from the reporting period beginning on or after 1st January 2023. So it means all the accountants or the reporting managers, financial reporting manager, they have to update their accounting policy as material accounting policy, rather significant. So this is the work required for the accountants this year. The next one is definition of accounting estimates. This is again another change, as well as the effective date again from the 1st January 2023 or later, like beginning from basically. So accounting estimate new definition is a little bit different than the previous one, where the standard is saying this member stands for monetary amounts of financial statements that are subject to measurement uncertainty. So previously, accounting estimates were given a definition of like any assets or liability or periodic consumption of an assets which is subject to adjustments or that result from the assessment of the present state and expected future benefits or obligations associated with it were supposed to change. So that definition has been updated, whereas accounting policy definition is exactly same, but standard this time clarified here, if it is difficult to determine the change in accounting policy from the estimate, like if you are having difficulty to determine whether the change is accounting estimate or change is accounting policy, then you can treat such change as an accounting estimate. So this is a big relief which standard is giving, but this is again a subjective thing where maybe the auditors or the users of financial statements can have a different opinion about the matter. But I can say the standards has clarified all the accounting estimates or the changes, accounting estimate or change in accounting policy in the relevant standards. So guidelines are pretty much clear. So, but still they are allowing you to determine that if it is difficult to differentiate, then the change will be considered as an accounting estimate. So generally everyone should have understanding that wherever the change in accounting policy is, so we are saying generally it's a retrospective impact, and wheresoever we have a change in accounting estimate, so it's a prospective impact. So this is a general guidance of IFRS. So I have made a few questionnaires where we can go one by one the cases, and let's develop our understanding with regards to to some definition or interpretation of IFRSs. So the first item is IS 16, depreciation method. Is it accounting change in accounting estimate or change in accounting policy? Either you can raise your hand, or otherwise, if you can type your answer in the chat box even, so I can say. If your answer is change in accounting policy, you can type 1, or if your answer is change in accounting estimates, you can type 2. If I can quickly see, I'm opening the chat for everyone. Now everyone can type in the chat box rather in the question box. Okay, so Ali Asgar, you have raised your hand. I have opened up the mic for you.
So the chat box is still disabled.
Okay, let me see why it is happening. Everyone. Okay, everyone. Now it should work for everyone. Okay, so whosoever is in the favor of change in accounting policy, you can type 1, or otherwise type 2. Okay, most of the people or participants are saying it's change in accounting estimate. So we can see, yes, it's a change in accounting estimates. Now the effect should be retrospective or prospective. So in case of retrospective, you can type 1, or in case of prospective, you can type 2. So fine, this is the simplest answer everyone has given. It's okay. Now let's move to the little bit complex example. The next one is again IS 16, cost. Moving from cost model to revaluation model. Is it a change in accounting policy or change in accounting estimate? 1 for policy, 2 for estimate. Okay, so everyone is saying almost a change in accounting policy. That's fine, that you are right. But what about the impact? Is it retrospective or prospective? In case of retrospective, 1, and in case of prospective, 2. Okay, here we have a mixed answer, but it's important to understand for everyone. Standard has clearly mentioned that the impact or moving from cost model to revaluation model is prospective rather retrospective. You would have seen even the financial statements of the companies where they have changed I can say measurement techniques from cost model to revaluation model, but there is no retrospective impact. The reason being, standard has clearly defined this kind of change or gain or loss in the OCI, which is ultimately going to or hitting to your retained earning, and you have to specifically disclose those circumstances. So that's why standard is allowing, and categorically they have mentioned to make this as a kind of prospective change, but it's as per the guidance of IS 16. The next one is IFRS 13, market versus income approach to fair value the financial instruments using level 3. So is it a accounting policy? Policy mean 1, or estimate means 2? So answers. Okay, everyone is saying it's policy, whereas this is estimate. Basically, here you are not going to adopt any cost or evaluation model. Here, you are supposed to change the valuation method, which is an estimate. You are not, it's not controllable factor. It's somehow linked to the judgments. So that's why it will be considered as accounting estimate, and accordingly, if it is an accounting estimate, so the impact should be prospective. Okay, can I see if anyone has raised the hand? Askar, your hand is still raised. You want to, if you want to ask any question, mic is open for you. Okay, no more question. Okay, the next one is IS2 cost formula. Cost formula, if I explain here, we have, two types of um, level 3 Wajid. It's like for financial instruments valuation, we have different type of techniques to do the valuation. Let's say level 1 is we have comparable, I can say either equity or share values or industry. Let's say your company's shares are listed in stock exchange, so you have direct valuation. You can take the numbers from Tadawul or stock exchange, market share or market capitalization of your shares. So that is level 1. So similarly, the level 2 and level 3, it's a different category to measure the valuation. I cannot go into that details, but those are basically sort of estimates to measure the fair value. Cost formula, as I mentioned, is sometime the entities are moving from weighted average method to FIFO, first in first out method, with regards to inventory costing. So is this a accounting estimate or policy? Change in accounting estimate or change in accounting policy? So again, for policy 1 and change estimate 2. Okay, so many answers, I can say mix. Fine. Basically here, this is an accounting policy. The reason is, if you see the definition of accounting policy, they are saying specific principles, bases, conventions, rules, and practice applied by an entity in preparing and presenting the financial statements or part of financial statements. So it's a specific rules or principle and guidance. It's not a valuation model where you have to think the about the estimation of the IS2, but here it's really a guidance which you are following as it is. FIFO is a convention and guidance, that, or you can say, other rule, or similarly weighted average is a rule. So this is change in accounting policy. But what about the change impact? Will it be retrospective or prospective? Again, for retrospective 1 and for prospective 2. So answers. Okay. So here the change is basically not as per the general guidance. It is prospective, because in IS2 it is already, they have clarified that whatsoever the convention you are going to change from one model to another, from FIFO to weighted average, or vice versa, this change will automatically captured on year-on basis through the balance sheet, and standard has categorically mentioned this kind of change is basically prospective. So so you can see sometime general basically IS 8 general guidance is applied, but not in all the cases. Generally, yes, everyone knows retrospective impact means change in accounting policy means retrospective effect, and change in accounting estimates is prospective, but it is not in all the cases. Standard has clarified in many situations how you have to do. The last thing, cost or equity method to record the joint venture and investment in joint venture and associates. So is it a change in accounting policy or estimate? Again, one for policy and two for change estimate. Okay, so most of the answers are one. One means right. Everyone is right. It's a change in accounting policy. And how about the impact or effect? Retrospective one and prospective two. Any answers? Okay, yes, here you can say retrospective because IS 8 has clarified it, and it is as per the standard norm of change in accounting policy and change in accounting estimate, because there is no specific guidance on it. So accordingly, IS 8 is applied. Okay, we have
Muhammad
one.
Rizwan Amin raising
Okay.
hand.
Sir, as you had said that what I've understand up till now that there is a general principle given in IS 8 with regard to whether it is impacted retrospectively or prospectively based on the estimate for policy. If there
Yeah.
is nothing specified specifically in any other standard, then general principle would apply. Is it so?
Yeah. If standard
Okay.
has categorically mentioned, so we have to follow that. Otherwise, IS 8 will be considered as a viable.
Okay, sir. Okay,
And
thank you.
now standard is relieving a big load with regards to when they are saying when it is difficult to determine the change in accounting policy from the estimate, then you consider this as an accounting estimate. They don't want to go to the more complexities, but it's a subjective thing. Maybe your auditors would have opinion it's a policy, or maybe you would be expecting this as an estimate. So those are subjective thing where you have to reach to the conclusion with your management or with the users or with the auditors.
So it means the benefit of doubt should be given to the estimate if there is
Yes.
any difficulty, as you were saying.
Yeah.
Okay.
Okay. The next one change is international tax reform pillar 2 model. First of all, maybe a few participants have knowledge or may not have pillar 2 tax model. Anyone can explain what is this? I can open up the mic. If you can raise your hand, I can open the mic. Otherwise, I can explain. Okay, basically, it's a kind of global taxation where this international monetary agencies or World Bank or the different international agencies are working to develop the minimum tax regime, minimum global tax regime to set the base for the minimum taxation. So as per that, I can say guidelines or the rules, Pillar 2 is set as introduces a global minimum tax rate of at least 15% on the multinational enterprises. This minimum tax will be calculated or is calculated based on the financial accounting standards and relies on two main components like profit and tax paid. So for example, in any jurisdiction, let's say in I can say Saudi Arabia, if any multinational is paying the the standard rate of tax in any jurisdiction is, let's say, 10%, but that multinational is running the business, let's say in Saudi Arabia as well as in other countries. So as per these guidelines, they have to pay at least minimum 15% tax to relevant jurisdiction, rather 10%. So where it has to be paid, it's a different debate. I will not open up that subject now, but our purpose is to understand the change in IAS 12. So just focus on, if I focus on this one. So basically, let's say in any country, the taxation rate is 10%, but as per international tax reform or Pillar 2 model, you are obliged to pay 15% in case of multinational companies. So due to this reason, you will have a deferred tax, either asset or liability, it depends. So under such circumstances, standard has immediately clarified, and they are saying deferred tax with regards to Pillar 2 tax is exempt. Exempt in a sense, no need to calculate the deferred tax on the Pillar 2 so far. So far, they have forbid not to calculate any deferred tax because of these international tax reforms. So this is basically applied immediately. So no need to do a deferred tax calculation. But there are certain conditions. It depends on the Pillar 2 model enacted by any regulatory authorities for the specific countries. Let's say if the country is adopting this Pillar 2 model, then the regulators of that country will definitely emphasize how and in which way we have to record the current taxation, and accordingly, deferred tax impact will be recorded. So, as I mentioned, they have clarified, IFAC has clarified not to calculate any deferred tax due to this reform, but they are saying entities should disclose the separately its current tax expense relating to Pillar 2. So definitely, deferred tax you need not to calculate, but you have to disclose the current tax expense. And in the period in which the Pillar 2 tax legislation is enacted, although deferred tax you need not to calculate, but you have to disclose the estimate or reasonable estimate information that will help the users of financial statement to understand if we would have to record the deferred tax, then how much it would be. So it's just a extra disclosure, rather financial impact. So this is, again, this change is implemented from 1st January 2023. The jurisdiction which I know, let's say in the Middle East, no one has basically adopted this international tax reform. So I can say it's not applicable so far. So I'm just going to the questions. So far, I don't see any question now. Yes, Dr. Saab, let me open up the mic for you. Yes, you can speak now.
Hello, hi, how are you?
Yeah, fine.
I have a question regarding tax. If I have one company from UK that do service here in Saudi Arabia, and then they are taking 15% for tax. That is, and company from UK that argument that said that should be refunded. Based of this is should be exempted or no refund based of Saudi regulation.
Basically, there are two things, Dr. It depends, is it a withholding tax or is it a corporate income tax? Here we are just talking about the corporate income tax. Normally for corporate income tax, there is no kind of tax credit available in other jurisdiction, but yes, with regards to withholding taxes, some sort of exemptions or tax credits are available in other jurisdiction. So I can say in this case, they will see, let's say the multinational enterprise head office in UK. So they have, I'm giving a, for example, I'm just saying, for example, if that multinational subsidiary in Saudi Arabia, if they have paid 10% corporate income tax, so in UK, they have to pay the differential of 5% as well.
Yeah,
So this is like international tax reform. But what you are saying, that is more likely towards the withholding tax concept, which is not relevant with regards to IS 12.
yeah, it's okay.
Okay.
Okay, sir.
Thank you. So this is, I believe, clear. So no need to talk further. So the next one is non-current liabilities. Non-current liabilities with covenants. This is again a big change, but the good thing is it is not effective for this financial year. It is effective from the financial year starting from 1st January 2024. But I think accountants should prepare for this one. Now, okay, let me just give you a little bit background. Everyone is definitely aware of classification of non-current liabilities with regard to their current portion and as well as with regard to their non-current portion. Everyone is well aware about it. And the background is earlier, if I take an example of loans. So earlier, what was happening, auditors were, or even the management was just kind of calculating or assessing their covenants, and even your stakeholders like banks were assessing the covenants based on the audited financial statements or your quarterly or yearly financial reports. And they were allowing you some sort of waiver on the covenants or not waiver on the covenants, and accordingly the effects would have been disclosed in the financial statements, or rather like either current liabilities or non-current liabilities. I'm hoping that everyone is aware of all these things. Now, what standard has brought in, so they are saying just you need not to disclose your liabilities, but you have to also disclose your covenants. Whether you are whether an entity is complying with those covenants or not, it's a separate debate. You have to, I mean, the entity has to disclose the covenants as well, along with the borrowing notes. So now I can go through the slide. So key changes, again, classification as a current or non-current. So if you have a contractual right to defer such settlements over the period, like more than 12 months, so that is non-current. And if it is less than 12 months, it's a current. But the important thing is the second bullet point, liabilities with the covenants. You have to, they have also mentioned the classification criteria. I'll maybe showing you on the next slide as well as the disclosures. So an entity's right to defer the settlement of a liability for at least 12 months after the reporting period must have substance. It means either contractually or the way the documentation interprets. And it has been already illustrated in the new paragraphs. So they are saying there should be a substance exist at the end of the reporting date, so that you can classify the liabilities either non-current or current. Right may be subject to entity complying with the covenants of specific loans or not. Again, everyone is aware about it, but now you have to disclose the covenants as well. So how the classification will be, and the covenants with which an entity must comply after the reporting date, like future covenants, it's a future covenant. So no change in the classification, like definitely if it is relating to future covenants, so you need not to think about the current or non-current classification of any loan. That will be part and parcel of your normal reporting package or requirements. But if the covenants with which an entity must comply with or before the reporting date, so affect the current or non-current classifications liability. Let's say for 31st December 2024, a certain covenants are not being met or will not be being met, then you have to definitely, basically as per the contractual arrangement, you have to disclose those liabilities either current or non-current. This is one thing, but the important thing is disclosure requirement. The disclosure requirement, they are saying you have to disclose the covenants as well. So information about the covenants, including the nature of those covenants and when the entity is required to comply with them, and the carrying amount of related liabilities as well. So this is the requirement with regards to disclosure. Then the facts and circumstances that indicates the entity may have difficulty in complying those covenants, like for example, any action or mitigation plan which you are going to have to meet those future covenants. So example, we have a 5-year rollover loan, which is subject to debt and equity ratio. Like it's a rollover loan. Normally, rollover loans are being considered as short-term loans. Everyone, I mean, I think can easily say the rollover loans are short-term loans, but there was a condition like you have to maintain certain debt to equity ratio. Yes, the loan was rollover, but if the entity is maintaining such debt to equity ratio over the period, so the entity can classify such loan as a non-current because covenants are meeting. And contractually, again, we have to go back to do the contract with the banks or financial institutions. So if really helping you, rather just mentioning the rollover loans as a short-term borrowing, you can classify such loans as a non-current liability if such requirements are being met. So accordingly, you have to disclose the nature of the covenants. So on the other hand, we have a 5-year MTL loan subject to debt to equity ratio. So definitely it's a medium-term loan. So medium-term loans is definitely non-current if covenants meet. If not, definitely differentiate between the current and non-current portion, or accordingly as per the agreement. And in the disclosure, for sure, you have to disclose the nature of covenants and the facts as well. So it's a kind of big change. Normally, companies don't want to disclose these kind of facts. So here, it's clear, basically a guideline from the IFRS, which we have to manage to disclose. I'll take a break here for the question. Unable to speak, all right. Azhar Hassan, if the company had a head office in KSA and other branches in Canada, Dubai, and Pakistan, what tax rate will be paid? It depends. It's for multinational companies so far. So wherever the multinational has a head office, they have to pay the differential in that country. But further clarifications will come later on. Okay, so any hand raised? Dr. Sab, your hand is raised. If you can ask any question, I'm unmute. Okay, Dr. Saifuddin, I'm not able to hear you.
Yes.
Yeah. You have any question?
No, thank you.
Okay, so I'll lower your hand. Okay. The next one is lease liability. Just a second. Okay, lease liability in a sales and leaseback transactions. I will not explain this change in detail. The reason is it requires a lot of examples and scenarios. But for the sake of your update, I can tell you there is a change. which maybe we'll have a separate session on IFRS 16. We had in the past, but we can have again to discuss this concept in detail, where this change can also be discussed in detail. But um, the standard has given an option for subsequent measurement. So let's say the initial recognition time, the seller lessee, in case of sales and leaseback, includes the variable lease payment when it measures as a liability arising from a sales and leaseback transaction, and the impact was basically recorded in profit and loss, as per the standard. Now, what basically standard is saying, in case of subsequent measurements, the seller lessee applies the general requirement for the subsequent accounting of the lease liability, such that it recognizes no gain or loss relating to the right of use as of asset or retained. Basically, in this case, part of all the rights of use of the right of use for the seller or the lessee held before the lease modification is terminated. So any gain or loss relating to that partial or full termination of the lease does not therefore relate to the right of use retained. So that's why standard is saying you can entity can uh, um, basic no need to translate into the gain and loss in the no need to record such gain and loss. Rather, it can be knocked off with the lease liability. So I'll not go into details here because it's a little bit complex scenario and it requires some scenario testings. It depends whether you have a gain or loss on sales and leaseback or not, and then further how to record the retained portion or right of use terminated or retained, basically. Okay, supplier financing arrangement. It's I can say this is the concept. Although I can say it's an old concept, but these days most of the entities are going for this kind of supplier financing arrangement. So what is supplier financing arrangement, by the way, if anyone can answer? Iqbal. Yep, Mr. Iqbal.
Iqbal Sharif is raising hand.
Yeah,
Of
Mr.
Basil.
Inshaf Fazil, yes, I just opened up your mic.
I think this is enabling the our customers or customers and vendors. We are giving due days, like let's say 30 days for the customers and 60 days for the supplier. So in this way, we can arrange the financing agreement between our customers and suppliers.
Yeah. Okay. Anyone else? Okay, I'll be yes, Inshaf, you are
I
right.
think it's the agreement, yes, between the bank and you, your company, your entity, that you will be paying to the supplier, I think, with the certain amount on a maturity date, but you will paying to the bank on the maturity time, but the bank will pay to your supplier on the immediate on the date of the I think receiving the invoice or whatsoever. It's like that, is it?
Yeah. Okay. I'll yes. Somehow you are on the track to answer this. If I just now clarify in detail, so supplier financing arrangements are characterized by one or more finance provider offerings, like to pay the amounts an entity owes its suppliers. Like let's say you have a 90 days term, 90 days credit terms with your supplier. And on the day one, suppliers say, if you give me, let's say the required funds today, rather after 90 days, so either he can agree to bear the finance cost, or he can agree to give you some discounts to the entity, basically. So this kind of financing these days banks are arranging, in which what bank is doing, I'm just trying to explain this supplier financing. What banks are doing, they will pay to your supplier on the 0 day, either the contract with the customer, or having the contract with a vendor. So they can pay to the supplier on the day one or day 0, and they will record this a kind of LC arrangement between the I can say borrower and the lenders. And once the 90th day will reach, so bank will basically request the fund to the borrower, and will also show in the bank statements. So this is common in Saudi Arabia as well. So from day 0 to day 90, they will show either like kind of LC arrangement. So you will not see that in the bank statement, you will not see that bank has given you any credit or any money. So it's a kind of recourse or non-recourse financing facilities, with the extension of a little bit more relief on the supplier side. So this is basically supplier financing arrangement. Under these arrangements, when you have a liability towards a bank, or entity has a liability towards a bank, or supplier has a liability towards the bank or not, or customer has a liability towards the bank, so this has been explained in this change or update or amendment from in the IFRS 7 and IFRS 7. So what they are saying, the entity has to disclose such information about the supplier financing arrangement. So as I mentioned, on the day 0, if the bank has paid to your supplier, but still in your books of accounts, you have balance payable to supplier, on the 90th day, when the bank will claim for it, then you will basically settle directly with the bank and close the balance with the supplier as well. So in this case, entity has to disclose this information about the supplier financing arrangement, that enable the users of financial statement to assess whether those arrangements on the entity's liability and the cash flows are how being exposed for the liquidity risk. So terms and conditions you have to mention for this arrangement: carrying amount and associated line items presented in the financial statements you have to mention as a disclosure. Carrying amount and the associated line item for the financial liability disclosed under this point number 1, which have already received the payment from the financing service provider. And the last one is, you have to mention the range of payments due dates. Why it's required? So it will really impact, like a kind of in your IFRS 7 note, it will show your liquidity pattern as well. So that's why it is important to mention the range of due dates payments. Let's say those are current or non-current, or within 6 months due, or more than 6 months due, or something like that. So this is important to disclose somehow. Okay, here if before I'm going for the question answer, I have one question to everyone. So how our cash flow will look like as per IS 7? So is it a cash transaction? Let's say if we have received these kinds of financing arrangement on 30th of November, and the credit days were 90 with the vendor, with the supplier. So in between you have a year end. So at year end, so will you disclose this transaction as a cash item or non-cash item? How it will look like? For cash item, you can mention 1, and for non-cash item, you can mention 2 in the chat box. So yes, most of the answers are 2. Yes, everyone is right, because although your working capital load has changed, but accordingly, you during at the reporting period, you have to record such liabilities as a loan. So in that case, yes, it will be considered as a non-cash transaction. Okay, so the question from Rizwan. Yes, Rizwan.
Sir, I have a very, I want to share a very short scenario and want to confirm whether this falls under the supply finance arrangements. I am presuming that supplier here stands for our vendor or vendor of entity, isn't it?
Yeah, yes, suppliers of
So,
vendors, yes.
so we are right now getting or finalizing financing model where one option is to get finance for $1.3 billion from bank, or getting negotiation with foreign vendor, as we are the importer, foreign vendor for the period of 3 years. Instead of getting loan from bank, we are negotiating with vendors to give us the we will purchase a machinery amounting to $1.3 billion, and we would be able to pay within the 3 years with to the vendor, instead of getting loan from bank. So this would this be supply finance arrangement, fall under for supply finance arrangement?
No, that the way you have explained, or to the extent you have explained, that is not supplier financing arrangement. This supplier financing arrangement basically is a tri-party relationship where one financial institution is involved, you being as a customer involved, and your supplier or vendor is involved. It's a tri-party relationship. In that case,
Okay.
this is the requirement and IFRS interpretation. But what you are explaining, it's basically a direct credit facility with your vendor itself. That there you have a two-party relationship. So other standards may apply over there. Depends on the contractual arrangement, whether that can be considered as a lease or that can be considered as extended credit facility with
It is
that
a
partner.
extended credit facility mostly, most
Could be,
probably.
but not, it is not falling under this category, because here you should have a tri-parties rather bi-parties.
Okay. Thank you, sir.
Okay.
Taj
The
Mohammed.
next. Okay, so yes, who is asking for any question? Muhammad Rizwan. Okay, you are in Shaf as well.
I have a small question. What about performance bank guarantees, sir? That also will fall under this?
Performance bank guarantees, no, those are not really a financing facility. That is just a guarantee.
Yeah, it will come with along with the international trade. Just I wanted to clarify that, because sometimes we will go ahead with LC when you are doing transaction. So that will be a supplier financing arrangement, right?
That is
When you are
also LC is also, but in case of LC, there is a little bit difference here. Here, basically, you have already received either goods or whatsoever. I'm not going to that debate whether you received goods or services or not. But here, basically, you have a due credit, and you are going to pay to supplier on the day 0, right? But in case of LC, sometimes you have not received the goods, or you have different terms, like 40% LC or 100% LC or 0% LC. But that is really different. Here it's basically getting the loan rather creating an LC basically.
Okay, so the loan will be sanctioned to the customer of the bank or the supplier, like
both possible. Here, let's say you are basically doing the discounting. Okay, let's say your supplier can go to any bank and they can do the discounting. But in this case, supplier, you will have agreement with your supplier that your bank will pay to supplier on day 0. Okay, and with regards to finance cost, you can basically agree with the supplier. Either he will give you a discount on the early payment, or he will bear the finance cost. It's all tri-party agreement. So bank will be involving here 3 parties, including themselves.
Okay, sir. Okay.
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 Okay. So, Mr. Saifuddin, we have just 20 minutes left. We have more things to cover.
No, just I have nothing. Just for the guy who is talking about the machineries he's buying, that is definitely should go as a lease agreement long time for any machinery instead of to get financed. He will do the lease agreement with any company manufacturing for machineries. Then it will be based of lease, long time lease. Then installment, it will go based of the lease agreement. That is many companies that are using that. You will answer him as the lease is that is the right answers. Thank you for you.
Okay, thank you. Okay, so moving to the next item. So this is not a change, or this is not basically any. This is a practical problem which industry is facing, like the insurance contract. General perception is everyone is thinking that only with the insurance company we can have an insurance contract. It's not like that. So IFRS 17 can be applied to your entity as well, which is subject to this kind of chart. So it's not necessarily the insurance companies could have only insurance contract, but you can also have a insurance contract. Like sometimes you are asking for property, plant and equipment insurance or whatsoever the way. Due to shortage of time, we will have a separate session on IFRS 17, but I'll share with you these slides so you can see. And if you have any question, you can contact me personally. This is okay. I'm done with the latest changes with regards to IFRS for 2023 and 24. We have already discussed around 7 changes, and I have already mentioned the year effective date as well. So here are the further future developments which IFAC or IFRS body is looking into. Financial instruments with the characteristics of equity exposure draft will be prepared, and the due date is November 2023. But these are just future changes. I'm going to just tell you these are the proposal under discussion, but these are not really changes. So similarly, disclosure initiative for subsidiaries without a public accountability disclosure, or primary financial statements. This will be another change to IAS 1, International Accounting Standard 1, where they are going to change a little bit the presentation on the primary financial statements. The second comprehensive review or IFRS for SME is supposed to be or expected to be launched in 2024. I think the earlier version is 2015, and after almost 9 years, another amendment is coming in 2024. The main changes would be like from 2015 till now, whatsoever the changes have been adopted under the full IFRS, those somehow will be reflected in IFRS for SMEs as well. So, and the last one is important, the climate related risk in the financial statements. IFAC has already introduced 2 standards on sustainability. We'll cover in upcoming slides and what would be the disclosure requirements or impacts in future. Okay, now I'm switching to the another topic, which is basically IFRS Foundation kind of structure. So IFRS Foundation Monitoring Board, then we have IFRS Foundation Trustees. Under that, earlier there was only International Accounting Standard Board. So they were doing they were setting the standards with regards to IFRS and accounting, and they also had a IFRS Interpretation Committee. Now another board has been developed for International Sustainability Standards Board, which will look after the IFRS for sustainability disclosure standards. So as I mentioned, International Sustainability Standards Board, ISSB, is solely responsible for the establishing IFRS for sustainability disclosure standards. This new board has been formed in November 2021, and they are really working on a fast pace, and they have already issued 2 standards for state sustainability as well. So this is all about the formation of IFRS Foundation. Okay, now sustainability reporting. As I mentioned, ISSB already has introduced 2 standards on sustainability. You could be saying normally ESG requirements, environmental, and we have social and governance standards. So as per IFRS, we'll call it IFRS S1 and IFRS S2. So what is IFRS S1? If you see the left column, IFRS S1 basically deals with the general requirement for disclosures of sustainability related financial information. I have mentioned the scope. An entity shall apply the standard in preparation, in preparing and reporting the sustainability related financial disclosures, especially all sustainability risks and opportunity will be disclosed in the financial statements, including key reporting areas with regards to governance, strategy, risk management, metrics, and targets. Basically, you have to comply with the ESG requirements and disclose those climate changes requirements enacted by any regulator or any government should also be disclosed and properly accounted for in financial statements. So this is the requirement of IFRS S1. Out of scope, they have mentioned the related risks and opportunities that could not be reasonably be expected to identify or to calculate. So there is another standard which is basically extension to the S1 climate related disclosures. So you have to disclose the climate related physical risks as well as transition risks as well as the opportunities available to the entity. So I'm not going to the detail because this requires a separate session, but I'm just trying to give you a hint that, as I mentioned in this slide, the climate related financial risk and financial reporting is required from Q1 2024. Now these kind of standards are also required the regulator or government's approvals, or let's say in Saudi Arabia, if the government has any regulation with regards to environment or sustainability, so those will be followed, and accordingly the disclosures will be basically formed. So far, the standard has not been adopted by SOCPA, these standards, but as per IFRS Foundation, this standard is basically applicable from 1st January 2024. But SOCPA has to basically announce the effective date or date of I can say, enactment in Saudi Arabia. So any question here, because I have one topic left. Yes, video session will definitely share. Once you will receive your CPD certificate, you will have a presentation as well, but video session will be available on IFA YouTube channel only. Okay, okay. No more question available on my screen. So I'm moving to the next topic. Okay, I have one hand raised. Okay, so moving to the next topic. This is just a year-end reminder to all of us, being accounting and finance professionals. This is not a topic, but just a reminder what you have to prepare for your year-end audit process or year-end closing process. Definitely, I just highlighted here a few aspects which you should cover. Definitely, you are well aware of the an entity's financial affairs, but I just try to summarize here the main items. Like revenue recognition is normally important area for year-end preparation. Impairment of non-financial assets, like impairment of property, plant, and equipment, or your investment properties disclosed in the financial statements, or investments in joint ventures or associates. So different models can be applied, but it's just a reminder for you to be prepared for that. And then financial assets and liabilities, like most common people or accountants are seeing expected credit loss model, as well as loan covenants, which you have to look into whether you are complying with the loan covenants or not, or accordingly what will be the disclosure for financial assets and financial liability. Actuarial valuation of employees' benefit is one of the important activities for the year-end process. And the next one is inventory NRV is important, and I can say the area which the auditors are looking for. It's a small test, but it's important to close the year-end financials. Then provisions and contingencies as per IS 10. Leasing. Now, if you have any new lease, just go through the contracts, whether you have a new lease or you have to update your existing leases or whatsoever the way. It's just a reminder, and then ultimately overall presentation disclosures of the financial statements. So this is it from my side. I'm done with my presentation. Before going to the question answer, here you can see my detailed, and you can anytime ping me or send me your questions if I will not be able to answer within the time today. And before I open the session for Q&A, the last and important messages, two messages are: one is you have to you can register for the upcoming webinars. I have mentioned here the two webinars which are going to held in December. And I have mentioned the link as well, how you can register. But the members who are familiar, sometimes we are also sharing the links. The members or non-members who are familiar with the IFA website, they can go and they just can register for these two free webinars. The last message again, for IFA members who have joined the through IFA route, you have to renew your for 2024, and renewal is just not paying the fees, but you have to also file the annual membership return. So thank you. Now session is open for Q&As. So you can either raise your hand or you can type. Sanya, if you see any question, just let me know.
Salam, sir.
Welcome, sir.
I haven't seen.
Sir, first of all, I would like to appreciate the way you have presented the today's session. It was very knowledgeable and worth considering, obviously.
Thank you.
So, my question is that if you can give me a detail, not a detail, but a concept on the Pillar 2 concept that you have discussed earlier in IS 12. If you can brief it again. So I have some confusion so that it can be removed if you can assist me.
Sure. Basically, Pillar 1
Thank you.
is like the global bodies are just designing international taxation. So like let's say if you have your entity registered in Hong Kong, and the entity is paying, and they have a subsidiary in Saudi Arabia. So basically, I can say it's for multinational. So let's say the parent company is in Hong Kong, and subsidiary in Saudi Arabia. In Saudi Arabia, I'm assuming the tax rate is 10%, whereas in Hong Kong the tax rate is 20%. And as per this Pillar 2 concept, the minimum tax for any multinational is minimum 15%. So basically, by having a subsidiary in Saudi Arabia, they are saving 5% of international taxation. So as per IS 12, or before going to IS 12, the international agencies are saying you have to pay minimum 15% tax. Let's say, okay, I'll go to elaborate further later. But so in this case, so already parent has paid the tax for this subsidiary in Saudi Arabia 10%. So remaining they have to pay 5% in Hong Kong as a multinational enterprise or holding company. But let's say if tax rate in Saudi Arabia is 18% and international this Pillar 2 tax is only 15%. So no further taxation in Hong Kong. You are already paying more than the bar. So basically they have set this bar. So this is current tax only. So due to this reason, deferred tax may arise. So am I clear to you? Is it
Yes,
okay
sir.
now?
Yeah. Yes, sir. Yes, sir. Okay, sir. Thank you.
Okay. Anyone else? We have 2 minutes left. If I can open up the mic for any participant, if you can raise your hand.
See, hello.
Yeah.
Yeah, Mr. Sulaiman, just I have a question for CBD. I have, I think that is 22 from SUGBA and 30 from ACCA.
Okay.
That is, we should have to submit a copy or just to write the numbers of hours?
For CPD record, just you have to log in your portal and submit, there is a form, like predefined form. It has just 3-4 basically fields. You have to just fill in the information over there. No
Yeah,
need to.
They need a copy from the attendance of the seminar or the conference.
No,
I have
no.
It is okay. That is only, I have the certificate with me. Yes, I want to make sure if they are needed, I will upload it also, because 30 hours from ACCA and 22 from SUGBA Saudi.
Okay, so as a for the first instance, you need not to upload any documentation. Just you have to fill in that particular fields. But on sample basis, institute can ask for the record. I mean, yearly they are just let's say asking to the 5% of the members, whatsoever they have basically disclosed over there, they have to send the records. So for that purpose, they will send you email if they require anything. Otherwise,
So,
whatsoever you have disclosed, it's okay.
it is okay. It's okay, no more problem. Thank you.
Okay, so we have one
These
check.
two, what about these two seminars? It's going to be here with you here in Saudi Arabia, 21
No,
and
these are online webinars. One will be run through the first one. The speaker will be from Pakistan. I think Mr. Zafar. And
yeah,
for the
Mr.
second
Zafar.
one, the speaker will be from Sri Lanka. So those regions' international representatives will manage these webinars. So I may not be sending you through WhatsApp, but you can just go to IFA. I have mentioned here the path. So you just can go to the IFA website and can register for these webinars.
Which is okay. Thank you.
Okay, so I have question. I think IFRS 16, the company entered into an agreement for a lease of mall space. Okay, the next one is option of the company. The company has a right to construct the mall. Basically, in this question, I need maybe certain a little bit more clarity. But let's say if just the company is constructing and then they will hand over it to lessee. So at that point in time, you have to record such lease. But I need little bit more clarity. If you can either call me on this number, and then I can discuss with you further in detail. So okay, we are almost on the time. So thank you so much everyone for joining. You will be receiving this presentation along with your CPD certificates. UK team will share with you all such things. And if you will not receive your certificates or presentation after a week, so yes, after a week, so then you can inform me. Okay. Thank you so much everyone for joining. Assalamu alaikum, Allah Hafiz.
Thank you so much.
Thank you, Sania.